Okay, so if you want to take a few minutes, go through those, we'll go through and get the answers. Okay, so let's go ahead and walk through these questions. Again, they're not quizzes, they're just designed to help you see what's the type of questions that are gonna be on the test. And also, if you've read this material, like say you read the chapter, you don't get any of these, then maybe I'm doing something wrong, maybe you're doing something wrong, we'll work it out. Right? So primary source of stockholders' equity, when we think about stockholders' equity, There are other things that can be in there, but generally that's what's in there. Retained earnings is income retained from the company, right? So that first one, we would say, yeah, this qualifies, but we got to read the rest of them, right? Because you got all the above possibility. So appropriated retained earnings. So appropriated usually means they're restricted. And so it would generally not be included in there. And then the last one would be contributions by stockholders, and that's paid in capital, right? And that's common stock, treasury stock, gold stock. Uses. See. This answer here is D. Common stockholders of the business enterprise are said to be the residual owners. It's like owning the residual beer at the bottom of your friend's can, right? That sounds great. So what does that mean? Are entitled to a dividend every year in which the business earns a profit? No. The company does not have to declare dividends. That's why don't pay dividends. They're focused on growth. Have rights to specific assets of the business. You can't take your shares of Walmart stock and go in and say, this is my store, right? So it doesn't give you access to the assets. You're basically what's left over after everybody else is in line in front of you. You bear the ultimate risks and uncertainty and receive the benefits of enterprise ownership. And that's correct. Can negotiate individual contracts, on behalf of the organization or enterprise? You cannot. Direct costs incurred to sell stock, such as underwriting costs, should be accounted for as a reduction of additional paid in capital, an expense in which the period of the stock is issued, and intangible asset. So for the first one, it does reduce your additional paid in capital if you use additional paid in capital. If not, it would just reduce the value of the stock recorded on your books. An expense in the period is not an expense. It's one of those ownership transactions. So we don't count it as an expense, and it is not an intangible asset. So the answer here is A. When treasury stock is purchased for more than the par value of the stock and the cost method is used, what account should be debited? So here, we won't get to this entry or this today. We'll cover that on Tuesday. And so our answer here is C, treasury stock for the purchase price. Okay. Porter Corp purchased its own par value stock for $20,000 and debited the treasury stock account for the purchase price. The stock was subsequently sold for $12,000. The $8,000 difference between the cost and the sales price should be recorded as a deduction from. So essentially, what do we do there? This is the Dr. Goodchild investment strategy. Buy high, sell low. They wouldn't do that. They bought it because they thought it was. It's not really lost. It just reduces your paid in capital for the treasury stock, or if that's not available, then retained earnings. So that answer is A. Any questions on those? So I'll just make sure I type up the answers there. There's probably a handful. At least early on. At school, I think it was out. It's always considered silence. Is that it's resulted in large wealth transfer to shareholders because businesses used to invest those dollars. They say, listen, I'm going to buy a company. I'm going to give what they do. Is they pay it out in dividends or they buy back. So if you're a stockholder, how does that benefit you? Everything functions on sort of supply and demand, right? And if you're holding that stock and you reduce the supply, you expect your price to go up. So investors are looking. And there's kind of management, they'll say, our stock was undervalued, it was the best now there. So that's one of the reasons that they do it. The other reason is because stock compensation for executives, and even in some companies, all the way down to everybody, like I think Lowe's, if you go to work for them, I think they offer you like stock in retirement. And it's like a contribution to that. A lot of companies do that. They'll tell you, but contributions that you're putting in your 401k, 2% of it is going to go stock. And so if it's higher now, they can't do that with it. And their argument there is, well, we're doing employee compensation, but we're doing share. So what we're going to do is, are you guys familiar with Warren Buffett and Hurricane? So Berkshire Hathaway is essentially just an investment company, and he's nearly 100 years old. He's nearly 100 years old. And he's been investing. And if you look, it's really good years. You know, get up with the pressure, you get past it. Pretty much everything for those 30 years, 40 years after that are really good. You just got investing. Well, now we're here today, and he is just building a massive stockpile of cash because he thinks the market is sort of overvalued. So what he's doing with that cash is buying shares of Berkshire Hathaway rather than investing in it. So his argument there is the best thing I can do to get the best return is like. So those are some of the issues. I mean, there are other issues like you talked about, which is important. If you want to reduce the supply because you think somebody's buying it, take you over. And so it can help prevent that because it makes it much more costly for them to take it over. So that's an option as well. Good question. All right, so I'm just going to kind of do some short form definitions here. I think you guys know most of what this stuff is, so we'll kind of roll through it. The first, I don't know, half of the chapter is just kind of, hey, do you know what equity is? So that's what we'll get through today. So corporations, it's a company or group legally authorized to act as an entity. And just a little note, it's usually separate from owners. I say usually because what's happening now is that executives are getting paid so much in stock that they're often big owners in the company. Now, if you ask me who are the largest owners of stock, I would tell you companies like BlackRock that are investment companies. Their only competition out there, that size wise would be like pension plans from large states. So California, their pension plan's called CalPERS. I forget what New York is called, but essentially, even if you're an executive and you get millions of shares, usually you're not putting a dent in it anywhere near what these venture capitalists, these hedge fund people own, and the pension plans. And to be honest, I think while it benefits people with pension funds, it really leaves the people that are there still out, right? If you're solely focused on the stock price. Yeah, Google is the biggest company I think that's set up that way. You can, if you want to Google like Alphabet stock. Alphabet is the parent company of Google. So Alphabet has a Class A stock, and it has a similar value to their I think it's Class B stock, but one doesn't have any voting rights, or as you mentioned, one will have larger voting rights. So they're both common stock, but you don't get as many benefits. So that's the, internally held things like that. Those people are keeping much more control over it. So what we've seen in the industry is managers becoming more and more reliant on stock for compensation, and corporations sending more money to shareholders and less money into investing in growth and investing in their employees. So you have C Corp, right? C Corp, just kind of short and small difference. It's still a legal company, right? But this is how the difference between a CNS is that this can have an unlimited number of shareholders. The S Corp is limited to 100 shareholders. And in most cases, they're active. Active. Let's type in pass and got ass. I'm gonna search that. Okay. So I know you guys have had probably corporate tax already. What's the interesting thing about an S Corp? Excellent. So it's a pass-through entity. I forgot the A, or the P. Proprietorship is pretty straightforward, right? Single owner business. Partnership. A little more owners. You guys saw the graph? What's the largest number of companies in the United States? What are they made up of? Are they sole proprietorships, partnerships, C corps, S corps? Right, because pretty much anybody can start a business. So that to me is like the original soul. Two. Okay. Oh. But when we talk productivity, decoration. We're talking about Boeing. Have you guys been paying attention to what's going on in Boeing? What's that? Yeah, so just recently, I would look at that based on Boeing planes right now. It is safer than driving most of the time, but now if you're on a Boeing plane, there's not necessarily a guarantee there, right? I love this picture of this astronaut. Sorry, I didn't mean to pull up the New York Post if it is not a great magazine, but I just wanted to show the picture. That poor woman is stuck in space.
Just her?
Oh, these two. A weekend. And the shuttle was supposed to take them back after, I think it was 8 days, 4 days, something like that. Saying like 6 months or something. Now they're gonna get it done.
It's fine.
So they'll in total, instead of spending 8 days. It'll be 8 months there. Who's coming to the rescue? Space. SpaceX, so that they do anything with the spaceship. Yeah, you're taking out my home, right? So, and she's unfortunately not doing well up there, so, you know, maybe keep an eye out for it, but the Boeing Spaceliner has, I believe it's a hydraulics or hydrogen leak or something like that, and it can't come back safely, so they're waiting for the spaceship. Yeah. And like you said, doors falling off the Boeing airplanes. What else did Boeing have a couple of years ago? Allegedly, please say allegedly, so they don't come and get us. Their planes were also, the Dreamliners were the ones that. Kept pushing down. To. Yeah, there you go. They've been safer. So. Those type of corporations, huge. Boeing affects our GDP. And it affects what happens in terms of our trade imbalances, right? It's one to do that. So corporations have the power. And I'll add full Congress too, allegedly. Is that? What are the advantages of corporate formation? Limited liability. Does not apply to shareholders. If I'm a shareholder in Boeing, in most cases, you cannot be sued because of the actions of Boeing. And when I say generally, because there are behaviors that can get shareholders sued, even. So 99% of the time, limited liability is a really good thing. Right? Separate legal entity. They like this, but it really gives them quite a bit of power. Corporations have power to act as a human, right? Supreme Court said that corporations pretty much have same rights as a human. So and having the separate legal entity means that it's not associated with any one of the shareholders. You can still be a single shareholder and still have this shield. Ease of capital formation. So companies can raise money through shares, selling shares of stock. Or taking on debt. They have a lot of flexibility to create that company. Unlimited life. Corporations are expected to consider or to continue in perpetuity. Obviously, this is the case most of the time. There are clearly cases where corporations are set up for a short time, but most of the time they are expected to. What happens? Expected to continue. Fail. So what happens when one fails? They have to basically fair value their balance sheet and run everything through the income statement because they're have to liquidate it. And so investors no longer care about historical costs, courts don't care about historical costs. They will what you have in the building to pay off or debts. Ease of transfer of ownership. I asked my freshman today, I was like, does anybody have a stock account? That they kind of day trade on? Recognize that you that much, so I don't. Me, it's like a little like you. But in general, if you kind of diversify, then you can kind of hit spots. So me, I'm yeah. But it's so easy to do now, right? Or any type of percentage of stock. Yeah. Makes it so much easier. We were talking about Berkshire Hathaway and Warren Buffett, what's his stock at? I think it's somewhere near $500,000 a share now. That's his A share, his B shares are a little bit less than that. So I can sell my own share. Transfer either. This is one of the reasons that some companies will invest in the stock market with their extra cash because they know the return is pretty good. The book lists here professional management. Sorry, I didn't put the extra one on there. I think it was a little slip on my part because when somebody says professional management, I'm like, take the shares of my stock and pledge it for a company that's worth $10 billion for 40. You know, you have what's called, and they'll talk about it a little bit in the disadvantages, information asymmetry. So I'm the owner of the company. How do I know to? We're doing accounting, right? What kind of accounting? Which is what part of accounting? We're working there. We're getting there. Think about it. You have managerial accounting, tax accounting, financial accounting. So if you're an investor, you figure out how management is doing by what they say in the future. They help to that. If they're they generally not generally be helped, but if they act in bad faith, they can. But as owners of the stock, we don't find out anything until usually a month or two after we finish. And so we're looking at a financial statement. With financial statements are one company after their year-end closes. So that's how we know. But how does management know what they're doing? What's the other type of reporting? Managerial reports, right? And they seem much more than we see in the financial reports, and are much more fun and useful and forward. So there's an information asymmetry there that your owner, you're hoping they'll act in your best interest, but they could be acting in their best interest, and you won't be able to find out until later. Because you're watching what they're doing behind in arrears. So that's why I wanted to put a little star here, because I think obviously if we're investors, and let's talk about, if you're investing in the stock, you can't run 10 corporations, right? Think you can. Them into the ground, right? But so to me, I just make a little note. I feel like professional management can go either way. And disadvantages, total taxation on C corps. They tax the corporation. Does anybody know what the corporation is? Yeah. And of course, just like people, there are things they can do to based on tax. When they then pay out investors, you get taxed again as the owner. You get taxed on the dividends. And if you sell your stock, you receive. Now there, I don't get too much into the tax consequences of it, but there are two types of tax there. Sometimes it's better, right? You got short-term capital gains, long-term capital gains. Short-term is just like ordinary earnings. But long-term capital gains get taxed at what rate? Or, I'm sorry, it's different, right? What rate? It's usually 10 to 15%, right? So. What's that? Right, there are other tax things that they defer, but you're still gonna get taxed on it at some. If you're talking, they need things like to be for the average person, but there's a guy that put his stock, I think it was paid years ago, into his Roth IRA. And they Roth IRA, they show the tax and gains. So he puts, you know, a million shares, at the time, not a lot, but now it blew up and he's got one taxable gain that's nuts. So if I was teaching the tax course, I would pull it up, but just mind boggling what you can do if you have money. You can put it in structures that will defer your taxes, but eventually, maybe 200 years down the line, your heirs are gonna have to pay taxes on something like that. All right? Regulation. Indexes. Indices. Right? So indices would be like the NASDAQ, the NYSE, basically, not that you have the government regulations about corporations, but you also have regulations from the indices that say you have to maintain this, you have to do certain things to make sure that you're reporting. And just a note here. Regulation from the government, political regulation can be devastating. Rage from the people will cause conflict. To change the way the companies are operating. So we've seen the oh, that's Federal Election Commission. There are organizations right now that are challenging moving it. So like Clover, these are to stop it. Same thing with a few other recent things. They're trying to make Google and make Amazon operate differently, and so they're suing them. Which company? I'm sorry. Google. Google, right. It's well, so the Southern Bell did the same thing with somebody they're doing. You go out and you buy up all the smaller companies and then you raise your rates, right? So yeah, enforcement said we're going to give up. So now ACCT was one that came out of their and they basically separated so that there was competition. So they're even Southern Bell. That's awesome. Awesome. So what I mean is, it's not red versus blue, but it's regulation that results out of that political process. People are outraged at this happening. And starting by people trying to set tax. I think depending on who you talk to, you'll find people that want to raise it up and people that want to go even lower. What we've seen is that the dollars that come from corporations are much less funding our government as a percentage than they used to. Our federal government used to collect about 30% of its revenues from corporations. Now, what's switched to is individual taxes and your contributions to social security. We need no tax. And there are these states that have done it. Kansas had an issue a decade ago where they cut taxes to be local. Almost paid state, so they had to raise it back up again. That was Sam Brown Act, if you want to look at it. All right, so it's very important that you manage this. And it's just corporate gouging and things like that. We saw banks, the government forced a lot of bank mergers in 2008 crisis. And then also things like, they had that tire company that had bad SUV tires that kept stripping off and killing people. And so those types of regulations. What's that? Yeah. Yeah, their tires. I wasn't 100% sure, but you're right. And so it's huge. It can be devastating to a company. All right. And so here I talk about. And this is where we're talking about information asymmetry. There's two S's or one. It doesn't correct me. Okay, and this is where, like, even though that shows as a plus, I'm like, hey guys, it's not a 100% plus, right? The other thing too is that even though you expect professional managers to behave well, we've seen professional managers behave very badly. And if we think about the crisis, does anybody know or it was enacted in the year 2000? And when it enacted, it should have been. And 2000. That's next. The banking, gambling, the slowing in the economy, and because ethics are different than laws. So it's not always guaranteed that professional people aren't going to try to bilk you out of your dollars because you don't know anything about it. So as for me, take that carefully. If you see professional management, though, consider that a positive. Okay. And the last thing is common stockholders. The last in line for payment company fails. Typically, you'll have secured creditors. First. You'll have the lawyers and attorneys getting paid in bankruptcy. First, right? And then you'll have preferred. So unsecured regulars. And I would say right around the same time are the preferred, because preferred has kind of the same unsecured. Last. Common stockholders. I'm not aware of any bankruptcies where common stockholders got any significant amounts. Typically. You are fully at risk as a shareholder for what you invested. Get that last one. Jump to the next thing. Anybody else still need this? Okay, so what we're gonna do is we're going to create a simple stockholders equity statement from a trial balance. That does not make you happy, huh? Oh, man. Now, what I'd like you to do is, you need to kind of talk and chat about this. If you can come up with the stockholders equity section. Or the thing, I'm sorry, I don't want you to do this section yet. I want you to figure out what we need to include in this. To kind of get some checks. It's not a quiz. I'll walk through it and I'll give you guys about 5 or 6 minutes to do that. If you have any questions, flag me over. Okay, so let's, I'll give you a few more minutes after this to think about this, but let's start to kind of separate this out and say, what am I looking at? Right, so I didn't size these exactly, so I don't know how they're gonna come out. Um, okay, so I've got this first one here and it basically stretches from cash to accounts, above accounts payable. Yeah. So that's our first part of our equation. Assets equal our liabilities plus equity. So now here, what are our liabilities? Yes, so I'm close there and I'm not gonna mess with it. All right. And then what is our equity section? So technically it is the rest of it because what happens with revenues and expenses? Right, they roll into retained earnings. And so technically the rest of it, but I'm gonna leave this here for now and just call that equity. And then I'm gonna take this last one. And I'm just gonna call those. Correct. Yep, here it is dividends. And then this part here would be your income statement, accounts, revenues and expenses, and they roll into retained earnings. Key here, that we probably see on this site of thing. January 8th, and we're looking at this as of January 31st. So that has not been flowed out into retained earnings yet. So when we start to think about, okay, what do we got to do? We got to account for common stock. We got to account for dividend all the way through to dividends. Which by the way, when I do a statement, I just roll dividends into retained earnings and it reduces retained earnings. Right? Because you can see here's the 160 debit, but it's actually reducing retained earnings, right? So
Yeah, to just the two cars.
we're not doing anything with those. Now, this is the reason I like this trial down is because I could ask you to do cost of goods manufacturer statement. I could ask you to give me all these parts, what is cost of people, but all of that is kind of already here. Right? So we've got all this stuff that's already in there and it's in as revenues and expenses. So we don't have to make any of those calculations. What we want to do is net that out, figure out what it nets into, roll it into retained earnings minus the dividends. And then we're going to have our statement of stockholders equity, which we're going to work on. I apologize that it didn't print on yours. I had this in there, but I didn't have it dark enough for you. So So I apologize, that's not gonna be merged and centered, but essentially you want to write it on yours. So it's the company name, right? And then stockholders equity. And then what's the important caption or the timing of our non-balance sheet statements? whatever it is, whether it's a month, or it's a quarter, whether it's a year, for the period ending, blah, blah, blah. Remember with the statement of stockholders' equity and the cash flow statement and the income statement, it's a time period. A balance sheet is a picture on one particular day. Right? Okay, so you look and see what we've got here. We've got common stock. I'm not doing this in like perfect form, but I just want to hit the important parts. Right, and so your common stock is 2,000. And then you have paid in capital in excess of par. And usually I'll just call that PIC. And typically you want to tell, if you only have one share of one type of stock, you don't have to designate that stock. But if you have so here we have it's 284. I'm yawning. I'll go to sleep too. Right? And the way I would do it is I would put retained earnings. And I would net this out. So we're essentially looking at 644. And you guys don't have to put this all in here. 644 minus 160. Just going to sum up this side. I will, yeah, I put it up there. I'm trying to see if it'll tell me what my total is here. I know the X are too many windows open. Thank you. I do have the minus 160 there. So you said 6246. Okay. And then our credits, we had 7,400, 140, so 7540, 7594. Okay. And so we just want to net these. Now, sorry, this should be a negative, the 6246, because that's expenses, right? And so we just add that up. Anybody have a number yet? Or 4,160? I think that is correct, but let's
160.
116. Okay. Thank you. All right, so now this is total equity. Oh. That looks like. So this is 2,160? You have 1,832? Okay. Thank you. Wish I could just click on this and see what it is, but it won't. Fine. So. I can just do this. I don't know what I'm doing. 1832. So now we add this up. 416 was your total. So now, how do we check this? Do we know this is right? So you add up the assets, you add up the liabilities, and you find out whether or not assets plus liabilities equals equity. Any questions? So this is actually a really good stopping point. I love playing around with trial balances. I know I'm a dork. I can't help it. Yay! Thank you so much, and I will see you on Tuesday.